Hello and welcome to BQ Prime. I'm Hiral Dadia. One sector that has been in focus for good or bad reasons. One is it's the metal counters. In fact, 2022 has been a tough year for metal stocks, where throughout the year they have been under pressure. However, moving into New Year, we've seen a sharp rally that has come in. Now, what would this actually mean for the metal stocks, and what should investors do? Joining us on the show to discuss the same, we have Amit Dixit, analyst at ICICI Securities, joining in. Welcome to the show, Amit.
Hi, good afternoon. Thanks for having me on the show.
Pleasure as always us. Amit, my first question coming to you is clearly 2022 has been a complete downer with regards to metals as a sector. It's underperformed the benchmark as well. In fact, the index has risen 1% while the Sensex was around 4 to 5% in 2022. You had industrial metal prices which were trading at multi-month lows. There has been a sharp decline in the underlying commodity and metal stocks as well after April 2022. So rising raw material prices, stringent margins, a slowdown in China, plus a levy of heavy export duty in India, all these headwinds actually came together and stopped the metal stock rally. What's the sense that you pick up from here on, taking the entry into 2023 into consideration?
Yeah, sure. So 2022, a fourth was besieged by a lot of headwinds, as you rightly mentioned. Now, going into 2023, if you look at it, there are quite a few positive developments around China in particular. That in China, the COVID restraint, as we know, has been removed. Into 2022, we had zero tolerance policy towards COVID. So this is a big shift as far as the metals is concerned, as far as the downstream industry is concerned. Now the proof of pudding is in eating. So we have to wait for Chinese New Year and after Chinese New Year to see how these stimulus measures actually shape up. Because do remember that this particular period, January, February, or I mean, this time Chinese New Year is in January actually. So this particular period, December to January, is little bit seasonally weak in China because construction demand comes to standstill due to adverse weather conditions. However, after Chinese New Year, typically it has been warned that the authorities walk the talk on policies, walk the talk on stimulus, and therefore we see good growth in the next quarter, which is like April to June. However, this time around, unfortunately, we see another force, which is resurgence of COVID in China. Now, how much of whether these stimulus factors will actually be implemented in wake of the COVID resurgence that we are seeing in China is something that only time will tell. And we can all have guesses around that. There have been forecasts that, okay, by February we will hit the peak in China and then things will start. But and if you look at the statements of policymakers, it is very clear that they are trying to stimulate the economy. And once, if they do so, you will see that the next quarter would be typically quite good. So at present, it's all built on hopes, and therefore the rally in metal stocks has started precisely the moment China actually rolled back some of these stringent COVID measures. And whether this rally will sustain or not, it depends on how it actually pans out.
Right. So that's with regards to everything that has to do with, COVID, China reopening, as well as the kind of demand that would come in from China as well. Now, taking this into consideration, the other aspect that we're looking at, apart from, the China angle, is how are you seeing the metal prices to pan out? Do you think there is a possibility of a rise to come in?
Well, I would split it in two parts. One is ferrous, the other one is non-ferrous. Now, if you look at steel in last fortnight, and we have published a couple of notes around that, in which we have seen prices in traders market rising. In fact, the mainstream steel producers have taken a price hike in the month of January to the extent of 750 to 1,000 rupees a ton. So and if you look at from the other perspective, globally also prices have risen close to 15% in December. So therefore now the threat of imports is no longer there in steel. So steel prices, I would reckon that they have bottomed out. However, what matters is not just the prices but the spreads. So what is happening on raw material side, that coking coal once again is about $300. On iron ore, we have seen NMDC taking price hike. Odisha iron ore index is also rising because of the removal of export duty on pellets. So on the spread side, I would still see that picture is a little bit more sketchy in nature. However, having said that, Q4 is generally a period of good demand, and therefore we should see that in case of steel companies, Q3 in particular should see some expansion in EBITDA, material expansion in EBITDA rather, because of coking coal prices going down, and that was guided by the companies also. $80 to $100 is what they guided in their post earnings call. So
Mm-hmm.
that benefit we should see going ahead in Q4 because of prices rising. Essentially, the steel prices rising. So we have started Q4 fortunately on a very good note. And if this sustains, you will find that EBITDA per ton improving further. So steel is little bit of a the prices have bottomed out. Less risks are seen. As far as non-ferrous is concerned, well, non-ferrous is more governed by the inflationary concerns, the fears of recession, and therefore prices could remain range bound because still these fears have not abated. However, if it is the day it is clear that Fed has hit a pivot point, or the day the subsequent rate hikes are lower, followed by, of course, easing, you will find that even non-ferrous prices could go higher. But in the short term, I would expect them to remain really range bound.
Right. And with this, you have global steel prices also, which are appearing encouraging. Plus, you have domestic steel producers, which have already started to hike prices in Jan 2023. What would this mean from a margin perspective?
Yeah, so as I said, it's too early to say, first of all, for Q4 because these price hikes have been in response to the global price hikes. Now, we have seen surprisingly that this scenario is very similar to December 20, when there was a concerted price hike around the globe, and that is what led to a hike in Indian prices as well. But the macro scenario is very different. At that time, just about every country was stimulating the economy. However, it is exactly the other way around now. So, in that scenario, I would say that in domestic prices might follow the global trend. If in China things fall in place, if the stimulus measures are there, we
Hmm.
would see prices in India also rising. However, don't forget that export duty, the threat of export duty always looms. If prices are perceived to be inflationary, then there might be a threat of export duty being reimposed, because just that there is a precedent now. Previously, there was no precedent.
Right. So with the removal of the export duty, however, do you think the companies will be able to actually pull their profits up by, exploring overseas markets?
Yeah, so with export duty removal, while export prices are still at a discount to domestic prices, however, with removal of export duty, I would say that these would be margin accretive. When export duty was there, these were margin dilutive. So
Mm.
now these are margin accretive. So clearly, it gives a safety valve for steel companies to actually explore the overseas market and to cater to the customers over there. Even if margin might be lower, but for a steel company, it's important to run at optimal capacity utilization. And I think the capacity utilization of steel companies now would improve here on. Although on margin front, well, we would see how domestic demand span up, how your export prices behave. But capacity utilization definitely would improve.
Right. So overall, from a sector perspective, are you expecting a re-rating to come in? I do understand that the benefits of all of this that we're talking for the sector will not immediately accrue, but will be slightly deferred in the medium term. Overall, from an earnings perspective, are big earnings cut behind us, taking into account all the factors that we've spoken about, number one? And two, is there a possibility of a re-rating coming in?
See, currently there is a lot of optimism, as I said, in terms of stock prices. If you look at the valuation multiples, so stocks have actually re-rated. However, I see a room for further re-rating, provided there is some sustainability to the margins. Currently, we are all talking about hope, about optimism of China reopening, Indian demand coming back. If all these things happen, then of course, there would be a sustainable level of profitability that people would take cognizance of. However, stocks have reacted actually. And from if you talk from stock perspective, well, we don't really see a lot of upside in a lot of the names at present. However, one bad day in case of for global markets might just result in stocks coming off, and then it might make a good opportunity to get in these metal names in particular.
Right. So overall, Amit, if you go to see, stocks have gone up in that range of almost 4 to 16% in the last 1 week, right? Almost. If you see names like a Vedanta, Tata Steel, SAIL, or Ratnamani Metals, Nalco, MOIL, a JSPL, or a Hind Zinc, or a Hind Copper, Hindalco, all these names have seen good performance in the last couple of trading sessions. So if you have to actually bunch these out into stocks that could be an avoid right now, stocks that you could look to enter, and stocks that one should be holding if they already have position in, how would you actually club these names?
See, first of all, I would add a disclaimer saying that the days of metal stocks giving you a very healthy return are gone basically. So you have to settle with a moderate level of return. The reason being that because of the companies deleveraging their balance sheet, that beta factor in metal stocks is gone. So, but if I have to bunch these stocks, I still find upside of roughly 20-25% in JSPL. Our target price is 750 rupees over there. And these, we expect it not on the back of prices. We expect it on the back of cost efficiencies that are going to come in. At the same time, we expect that Tata Steel, we see it fairly valued at this stage. But SAIL and JSW Steel are the two stocks on which we have a avoid kind of rating. So yeah, so that is very clear. In case of Hindalco, we see an upside from here definitely, but not a great upside to be honest. It's around 15% upside. Our target price is 515. In case of Nalco, again, I see the stock fairly valued at this stage, to be honest. NMDC, for instance, fairly valued at this stage. So not a lot of upside left in these names. A name like APL Apollo, for example, that we cover. Now, this is a downstream steel company in which we see opportunity because they're expanding volumes. So there we still see an upside of 15%. In case of some of the smaller names like Shah Metallics, for example, where things are falling in place, there we see good upside, but one has to be patient in case of Shah Metallics. Jindal Stainless, another stock that we cover, we see an upside of roughly 20% from the current levels.
Right. So overall, if you have to sum up this conversation, Amit, what would you actually then advise an investor to do who's actually looking at entering the metal space?
Yeah, so I would actually advise people to wait for a while, let the Chinese policies, whatever we have been hearing, and we get to hear these a lot of time before Chinese New Year sets in. You would hear a lot of noise around policy and all. See, COVID is the reality in China currently, and going by the past, we have seen government being very, very stringent about it. And don't forget that in Chinese New Year, people typically go interact with each other, mingle with each other. So this COVID spread can be actually prolonged than what many people are building. So long and short of it, one has to wait for China, see how the Chinese policy shape up post New Year. If the stimulus measures are implemented, I would say that these stocks can give you good returns only if the prices moves up. Let us say Chinese price is now 600. If because of the stimulus measures, the price moves up to 650 or something. If overall China supported the metal space even in 2020, if it happens again, there could still be an upside of 20-30% over a series of names. But one has to wait at this point in time. I mean, there is no use of rushing in where, there are more unknowns than knowns at this stage.
Absolutely. So clearly, from what you're saying, it should be a wait and watch mode with regards to where metals as a space is concerned from an investment perspective. And as Amit is mentioning, a lot of unknowns more than knowns, and it's China, which will be crucial that one should be monitoring ahead of taking a call with regards to the overall pack goes. But clearly, there is some bit of momentum that's building in there, and what it would mean is something we need to watch out for. Thank you, Amit, so much for joining us on the show and sharing those views with us and giving us your preferences as well. Amit, any disclaimer that you would want to share?
No, so I mean, I don't have any position in these stocks, as I said. So this is the only disclaimer. If that is what you are looking at.
Thank you so much, Amit. Thank you so much for
Okay,
joining us.
fine.
Thank you, viewers, as well.